Are you worried about the upcoming estate tax cliff in 2025? Imagine safeguarding your estate without a huge financial outlay. Today, I'll reveal a smart, conservative strategy for using an irrevocable life insurance trust and term life insurance to protect your wealth. Hi, I'm estate planning attorney Mike Smith with Smith Barid LLC, and I'm one half of the estate planning guys. Let's start with the basics. The current estate tax exemption is $13.61 million per individual and $27.2 million for married couples without needing to do any really sophisticated estate tax planning. However, this exemption is set to decrease to around $6.87 million per individual on January 1st, 2026. And I'm hesitant to say exactly because the way it works is that we're going to revert back to where the estate tax exemption was before, which is a $5 million base exemption that's tied to inflation. And so we estimate that it's going to be somewhere around $6.87 million. Now, this significant drop could result in substantial estate taxes for many high net worth individuals. An irrevocable life insurance trust, or ILIT, is a type of trust designed to own a life insurance policy. By transferring the life insurance policy into an ILIT, you keep it out of your estate for estate tax purposes. So the death benefit does not count as part of your taxable estate. And this means that the proceeds from the life insurance policy won't increase the value of your estate, thereby potentially reducing your estate tax liability. Now, an ILIT provides several key benefits. The first is liquidity for estate taxes. The trust can provide immediate liquidity to pay any estate tax liability. And that ensures that your heirs won't have to sell assets to cover these taxes, like a family business or a family farm that might be very valuable, but not necessarily liquid. And so the proceeds from the life insurance benefit provide the cash to pay the estate taxes so that these illiquid assets don't have to be sold to cover that estate tax liability. The second thing is tax efficiency. Because of the way the ILIT is structured, the assets, the life insurance policy, and the ILIT are not a part of your estate. So it keeps those life insurance proceeds out of your taxable estate. So maybe even if you had an existing life insurance policy, and there are some rules around transferring existing policies out of your estate, but it might be a good idea to transfer that into an ILIT rather than keeping it as part of your estate. The third thing is that the ILIT allows you to dictate how and when the proceeds are distributed to your beneficiaries. So you can control exactly when it's going to be distributed. Now, that might be an immediate distribution if you're concerned about estate tax liquidity, or maybe you want to string it out over some period of time, depending on what your circumstances are and what your beneficiary's circumstances are. So I'm recommending to most of my clients using a term life insurance policy for this. And let me be specific, a term policy that can be converted into a permanent policy, into a whole life or a guaranteed universal life policy if needed. So why choose a term life insurance policy? Well, term life insurance is a cost-effective solution, and it provides coverage for a specific period of time, such as until the anticipated reduction of the estate tax exemption in 2026. So that means you get the necessary coverage without the expense of a permanent policy. And then if the exemption doesn't drop the way the law is currently written, so if Congress takes action and extends the current regime for the estate tax, or they come up with a different estate tax exemption and you don't need this ILIT, you don't need this policy anymore, you haven't invested a large sum in permanent insurance. It's pretty cheap to get, and then if you don't need it anymore, you can terminate the ILIT or just quit paying the premiums on the policy, and the policy goes away. So here's how you can implement this strategy. The first thing is you need to set up the ILIT. So that always comes first before the insurance policy. And you want to work with an estate planning attorney to create the ILIT. It does require some expertise, and so it's not something you want to try on your own. The trust will own the term life insurance policy, and that ensures that the proceeds are outside of your taxable estate. Then the next step is you purchase a term life insurance policy. You want to select the term policy that covers you until at least 2026, I mean, generally, you're going to want to get at least a 10-year policy with a convertible option. And almost every term policy is going to have the option to convert it to permanent insurance. But the reason you want that is that if the estate tax exemption does drop as it's scheduled to do, then you're going to want to convert this to a permanent policy. You're going to want to have the trustee convert it to a permanent policy and keep it in place going forward. So by buying the term policy with a convertible option, you keep all of your options open so that if the estate tax exemption goes down, you're covered. If it doesn't, you just let the policy go and you haven't spent a lot of money putting this in place.
So if you're interested in learning more about how we help families protect their legacies from probate, predators, and government intrusions, I wrote a free book titled The Ultimate Gift that lays it all out. If you'd like to pick up your free copy of The Ultimate Gift, simply click the link below, give us your address and a credit card for shipping and handling fees, and we'll ship it out to you free of charge. Read The Ultimate Gift so you can learn how to protect your family.
You want to ensure that the ILET is the policy owner and the beneficiary. So the ILET will control the policy while you're alive, and then we'll receive the proceeds when you pass away. And that's how we can make sure that it's outside of your estate. The third thing is you want to use annual exclusion gifts to fund the ILET's premiums. So there is an annual exclusion from the gift tax that is currently $18,000 per year. So that means you can gift up to $18,000 to a trust or to a beneficiary without there being any necessity to file a gift tax return. It doesn't use up any of your lifetime exemption. So as long as the premium is under that, you're good in terms of being able to make those annual exclusions, make it come under those annual exclusion amounts. And then you're also going to want to make sure that your trustee issues what's called a crummy letter. Your estate planning attorney will go over that with you in more detail, but it's basically a way to make sure that these assets stay out of your estate. Advantages to this strategy? Well, by adopting this conservative approach, you're going to maintain financial flexibility while effectively planning for the potential reduction in estate tax. So it's a win-win. It's affordable, it's efficient, and it's adaptable to future legislative changes. The alternatives involve things like potentially transferring highly appreciated assets into trusts or to trusts for beneficiaries or to charities. And all of those things are great from an estate tax planning standpoint, but they reduce your flexibility going forward. It might be assets that you want to keep. It might be, funds that you need to help take care of yourself. So any of those types of strategies that involve big moves could end up backfiring if the estate tax exemption doesn't drop. So this is a very conservative way to approach the potential estate tax cliff coming in 2025 without spending a whole lot of money or going to a lot of complexity. So to learn more about how an ILET and term life insurance can benefit your estate plan, download our free estate planning guide linked in the description below. Don't wait, protect your legacy today. If you found this video helpful, make sure to watch our next video on advanced estate planning techniques. Don't forget to subscribe to our channel for more tips on protecting your wealth. See you next time.